The morning of October 29, 1929. Wall Street is a storm. Inside the New York Stock Exchange, hundreds of traders are shouting, their voices cracking as they fight to be heard over the deafening noise. Paper from ticker machines spills onto the floor like snow. Prices are falling so fast, the machines can't even keep up. Outside, a crowd gathers, their faces pale. Some are crying, some are staring in shock. Others just stand there, silent, because they've lost everything. Imagine this. Yesterday, you were worth a fortune. Today, you are broke. Your savings? Gone. Your home? In danger. Your dreams? Turned to dust. All in just a few hours. They will call it Black Tuesday, the day the stock market crashed harder than anyone thought possible. Billions of dollars vanished. Banks failed. Families were ruined. It was the first domino that sent America and the world into the worst economic crisis in history, the Great Depression. But here's the thing. This disaster didn't come out of nowhere. For most of the 1920s, America had been celebrating fast cars, jazz music, skyscrapers, and the belief that the stock market was a money-making machine. People thought the good times would never end. They were wrong. So, what really happened on Black Tuesday? Why did the stock market collapse so suddenly? And how did it change the lives of millions of people around the world? To understand, we need to step back in time, to the roaring parties of the 1920s, to the rising bubble of greed and hope, and finally, to the chaos of October 29, 1929. This is the story of the day the American dream crashed. The Roaring Twenties. To understand the crash, we first need to understand the world before it, a time known as the Roaring Twenties. It was the decade after World War I, and America was riding a wave of confidence and energy. Cities were growing, skyscrapers reached for the sky, and jazz music poured from every club. The air was filled with excitement. People believed the future would only get brighter. New inventions were changing daily life. Henry Ford's assembly lines made cars affordable for ordinary families. Radios brought news, sports, and entertainment straight into people's living rooms. Electric refrigerators, washing machines, and vacuum cleaners turned chores into quick tasks. Everything seemed modern, fast, and unstoppable. Money was flowing, and people wanted to spend it. Department stores were packed, movie theaters were full, and dance halls stayed open late into the night. The economy was booming, and the stock market became the symbol of this endless prosperity. For the first time, millions of ordinary Americans began investing in stocks. And they didn't need a lot of money to do it. Banks and brokers introduced a system called buying on margin, meaning you could buy $100 worth of stock with just $10 of your own money, borrowing the rest. If the stock went up, you could make huge profits. If it went down, well, most people didn't think about that. Everyone seemed to be getting rich. Taxi drivers, farmers, teachers, people from all walks of life were putting their savings into the market. Newspapers ran headlines about record highs almost every week. The mood was simple. The good times will never end. But beneath all the glitter and jazz, cracks were starting to form. Factories were making more goods than people could buy. Farmers were struggling after the war, facing falling crop prices and mounting debts. And while the rich enjoyed their wealth, millions of working-class Americans were living paycheck to paycheck. The country looked strong on the surface, but its foundation was weaker than anyone wanted to believe. The stock market boom and bubble. By the mid-1920s, the stock market wasn't just a place for wealthy businessmen. It had become a national obsession. Everywhere you went, people were talking about the latest hot stocks. In barbershops, cafes, and street corners, the question wasn't should you invest, but which stock should you buy next? Big companies like General Motors, U.S. Steel, and especially RCA, the Radio Corporation of America, were the stars of the market. Radio was the new wonder technology, and RCA's stock price soared, even though the company had never paid a single dividend to its shareholders. People didn't care. They were convinced prices would keep climbing forever. The newspapers fed the excitement. Headlines screamed about record profits, and investment experts promised that the market was safe for anyone willing to jump in. stock prices began to rise far beyond what the companies were actually worth, a dangerous situation known as overvaluation. The real fuel for this boom was easy credit. Buying on margin became incredibly popular. For just a small down payment, investors could control huge amounts of stock. If the price went up, the profits were massive. But if the price went down even a little, the debt could wipe out everything they owned. Many people didn't understand the risk, or they ignored it. A factory worker might borrow money to buy stock, believing he'd pay it back easily once the price went up. A school teacher might put her life savings into the market after hearing her neighbor made a fortune. It felt like a game where nobody could lose. But the truth was, this wasn't magic, it was a bubble. Prices were floating higher and higher, completely detached from reality. And as history has shown us again and again, every bubble eventually bursts. Early warning signs, 1929. By the summer of 1929, the stock market had reached heights no one had ever seen before. The Dow Jones Industrial Average, the main measure of the market, had more than doubled in just a few years. On paper, millions of Americans were richer than ever. But some people began to notice the storm clouds on the horizon. Factories were starting to slow production. Car sales were slipping. Farm prices stayed painfully low. And yet, stock prices kept climbing. A clear sign that the market was no longer connected to the real economy. In August 1929, the Federal Reserve raised interest rates. Their goal was to cool down the overheated market and discourage risky borrowing. Instead, it made life harder for businesses and farmers already struggling with debt. Still, many believed nothing could go wrong. In early September, famous economist Irving Fisher confidently declared, "Stock prices have reached what looks like a permanently high plateau." It was a statement that would haunt him for the rest of his life. Behind the scenes, some of the wealthiest investors were quietly selling off their shares. They knew the prices couldn't stay this high forever. But the average small investor, the shop owner, the teacher, the factory worker, didn't see the warning signs. They kept buying. Then came October 24th, 1929, Black Thursday. The market suddenly dropped. Panic began to spread. Banks and big investors rushed in to buy shares and calm the market, and for a moment, it seemed to work. The market stabilized, but only for a few days. The worst was yet to come. Black Tuesday, October 29th, 1929. The morning of Tuesday, October 29th, 1929, began like no other. Even before the market opened, thousands of anxious investors crowded outside the New York Stock Exchange. Inside, the atmosphere was tense. Traders knew something was very wrong. The opening bell rang, and chaos exploded. Within minutes, a flood of sell orders hit the market. Everyone wanted to get rid of their stocks before prices fell further. The ticker tape, the machine that printed stock prices, was running hours behind, unable to keep up with the sheer number of trades. No one knew the real prices anymore, only that they were dropping fast. On the trading floor, brokers shouted until their voices broke. Phones rang nonstop. Paper littered the floor as sell orders piled up. It wasn't just numbers falling. It was people's life savings disappearing in real time. By midday, panic had completely taken over. Some investors sold at any price they could get. $100 stocks dumped for $10 just to escape before losing everything. Rumors of bankruptcies spread like wildfire. Outside on Wall Street, the crowds grew larger. Reporters scribbled notes. Photographers snapped pictures of men holding their heads in despair, and whispers of ruin filled the air. Banks couldn't stop the bleeding this time. The sell-off was too massive. By the closing bell, over 16 million shares had been traded, a record at the time. Billions of dollars in wealth had been erased in a single day. In today's money, the loss would equal hundreds of billions of dollars. For many, Black Tuesday was the end of the dream. People who had been rich in the morning went home broke that night. Businesses collapsed. Families faced an uncertain and frightening future. But the crash was not just about one terrible day. The market would continue to fall in the weeks and months ahead, dragging the country into the darkest economic period it had ever faced. The immediate aftermath. The shock of Black Tuesday didn't fade when the markets closed. In the days and weeks that followed, stock prices continued to slide. What had started as a sudden drop turned into a full-scale collapse. Investors who had bought stocks on margin were the first to be ruined. Brokers demanded repayment of loans, but with prices so low, selling their stocks didn't even cover the debt. People who thought they had built a fortune now owed more money than they had ever imagined. Banks began to feel the pressure. As news of the crash spread, frightened customers rushed to withdraw their savings. But many banks had invested heavily in the stock market themselves. And when those investments evaporated, they didn't have enough cash to give people their money back. Businesses across the country were hit hard. Without bank loans or investor money, factories couldn't pay workers. Shops couldn't buy new goods. One by one, companies began to close their doors. The human cost was immediate. Families who had once been comfortable suddenly faced the threat of losing their homes. Farms were repossessed. People pawned valuables, sold furniture, and searched desperately for ways to make ends meet. And yet, most Americans still didn't realize how deep the crisis would become. Many believed the market would bounce back quickly, that this was just a temporary setback. But the crash had set in motion a chain reaction that no one could stop. The worst was still ahead, the beginning of a dark chapter in history that would come to be known as the Great Depression. The Great Depression begins. By early 1930, it was clear that the crash was more than just a financial hiccup. America had entered a deep and painful economic crisis, a period that would be remembered as the Great Depression. Unemployment began to climb at an alarming rate. By 1932, 1 out of every 4 American workers had no job. Factories that had once operated day and night stood silent. Construction projects halted. Shops closed their doors for good. In cities, long lines of men, women, and children waited outside soup kitchens for a bowl of hot food. Families who couldn't pay rent were evicted, forced to live in makeshift shacks built from scrap wood and metal. These shantytowns became known as Hoovervilles, named after President Herbert Hoover, whom many blamed for not doing enough to help. In the countryside, the situation was just as grim. Farmers struggled with low crop prices, making it impossible to cover their debts. Many lost their land, and some became migrant workers, traveling from place to place in search of seasonal jobs. The suffering wasn't limited to the United States. Because the world's economies were connected through trade and loans, the crash sent shockwaves across the globe. Banks in Europe failed, factories closed, and millions more joined the ranks of the unemployed. The spirit of the 1920s, the energy, the optimism, the belief in endless progress had vanished. In its place was fear, uncertainty, and a daily struggle to survive. The crash had lit the spark, but years of economic weakness and poor policies kept the fire of the Depression burning. Government response. When the crash hit, President Herbert Hoover believed the economy would fix itself. He thought that if the government stayed out of the way, businesses and banks would recover on their own. But as the months passed, the crisis only grew worse. Hoover did take some action. He encouraged businesses to keep workers employed, pushed for public works projects, and supported the creation of the Reconstruction Finance Corporation to loan money to struggling banks and companies. But these steps were too small, too late, and didn't directly help ordinary people. One of the most damaging moves came in 1930, when Congress passed the Smoot-Hawley Tariff. It raised taxes on imported goods to protect American industries. But other countries responded with their own tariffs, which caused world trade to shrink dramatically. This made the Depression worse, both in the U.S. and overseas. Public frustration with Hoover grew. Many saw him as disconnected from the suffering of everyday Americans, a president who spoke of confidence, while people were losing their homes and lining up for bread. By 1932, the nation was desperate for change. The stage was set for a new leader to take office, someone who promised bold action and hope for the future, recovery efforts, and lessons learned. In November 1932, Americans elected Franklin D. Roosevelt as their new president. FDR promised a new deal for the American people, and unlike his predecessor, he wasted no time taking action. In his first 100 days, Roosevelt pushed through a wave of programs to stabilize the economy. Banks were given temporary holidays to stop runs and restore trust. The Federal Deposit Insurance Corporation, FDIC, was created to protect people's savings, ensuring they would never lose their deposits if a bank failed. The government began regulating the stock market through the Securities and Exchange Commission, SEC. This agency set rules for trading, required companies to be honest about their finances, and cracked down on risky practices like the margin buying that had fueled the 1920s bubble. Public works programs like the Civilian Conservation Corps and Works Progress Administration hired millions of unemployed Americans to build roads, parks, schools, and bridges. Not only did this provide jobs, it also rebuilt the country's infrastructure. Over time, these measures began to restore confidence. The stock market slowly stabilized, banks reopened, and more Americans returned to work. The recovery wasn't quick. The Great Depression lasted for nearly a decade, and it took the massive industrial push of World War II to fully revive the economy. But the changes FDR made reshaped the nation. The crash of 1929 taught hard lessons. That markets need rules to prevent reckless speculation, that banks must be trustworthy, and that the government has a role to play in protecting the economy and its people. Conclusion and emotional wrap-up. The 1929 stock market crash was more than just a financial disaster. It was a turning point in history. It shattered the illusion that prosperity would last forever and revealed just how fragile the economy could be. Behind the headlines and numbers were real people, families who lost their homes, workers who stood in bread lines for hours just to get a single meal, farmers who watched their land slip away. Dreams built over a lifetime vanished in days. But from that darkness came change. New laws and protections were put in place to prevent the kind of reckless speculation that had fueled the bubble. The experience taught America that stability requires both personal responsibility and safeguards to keep greed in check. Today, nearly a century later, the story of Black Tuesday still echoes. Financial markets rise and fall, and moments of panic still test our systems. History may not repeat itself exactly, but it often rhymes, and the lessons of 1929 remain as important as ever. The crash was the day the American dream stumbled, but it was also the moment the nation began to rebuild, stronger and wiser than before.